Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories within company reports. Today we're diving into Pelthos Therapeutics Inc.'s latest quarterly report, and let's just say things have been quite eventful for this biotech company. Pelthos Therapeutics Incorporated is in the business of developing and selling therapeutic products. They've got one main product, ZELSUVMI, a topical gel for molluscum contagiosum, which just launched recently in July. They also have some early stage products for pain relief. This filing covers the third quarter of 2025, ending the 30th of September. Pay close attention to the numbers here because they tell quite a story about the company's journey and future. Let's start by looking at their financial health. On the 30th of September 2025, Pelthos had about $14.2 million in cash and cash equivalents. That is a big jump from just $13,000 at the end of 2024. That increase is largely due to the merger and financing activities we'll discuss. Their total assets grew significantly to $126.4 million compared to just $1.4 million at the end of last year. On the flip side, their liabilities also grew. They had accounts payable of $5.7 million and accrued expenses of almost $11.9 million by the 30th of September 2025. Overall, total liabilities stood at around $68.2 million, a big increase from about $4.1 million at the end of 2024. This growth in liabilities is tied to their expansion and recent transactions. Now, let's talk about their equity. Their additional paid-in capital soared to over $101 million by September 2025, up from $18.8 million at the end of 2024. This shows a massive influx of cash from investors. However, they still have an accumulated deficit of over $43 million, meaning they've spent more than they've earned throughout their history. This is pretty common for companies in their stage of development, especially in biotech. Let's dive into their performance, or as is often the case with early stage companies, their potential performance. For the 3 months ending the 30th of September 2025, their net product revenues were $7.1 million. This is the first time we are seeing product revenue, and it is thanks to the commercial launch of ZELSUVMI for the same period in 2024. Revenues were zero. That is a massive leap. They also brought in about $294,000 in license and collaboration revenues in the third quarter of 2025. This is related to an agreement with Sato Pharmaceutical Company. For the same period in 2024, this revenue was also zero. So, total revenue for the third quarter of 2025 was $7.4 million, a huge jump from nothing a year ago, for the 9-month period ending the 30th of September. 2025, total revenue was also $7.4 million compared to zero in 2024. Now, revenue is great, but what about the cost to generate it? Cost of goods sold for the third quarter of 2025 was $2.3 million. This includes $0.8 million for inventory write-offs, which is a significant amount. This is also the first time we are seeing cost of goods sold because ZELSUVMI just launched. Selling, general and administrative expenses, or SG&A, jumped significantly. For the third quarter, it was $19.6 million compared to just $1.6 million in the same period last year. This massive increase is due to the commercial launch of ZELSUVMI, which involves building out a sales force and marketing efforts. They essentially ramped up their spending to support the new product. Research and development expenses decreased. For the third quarter, they were $145,000, down from $415,000 a year ago. This is likely because they are now focusing more resources on commercially launching ZELSUVMI rather than pure research for their pain programs. Amortization of intangible assets was $679,000 in the third quarter of 2025. This is related to the value assigned to assets acquired during the merger. With revenues finally coming in, the operating loss shows a stark picture of their investment. The operating loss for the third quarter was $15.4 million. While this is a large number, it is important to remember that a year ago, the operating loss was around $2 million. The increase in loss is directly tied to the surge in SG and the expenses for the product launch. Interest expense was $1.3 million for the third quarter, a big jump from just $39,000 a year ago. This is due to the significant debt and royalty obligations they've taken on, which we'll touch on more later. This brings us to the bottom line. The net loss for the third quarter of 2025 was $16.2 million. In the same quarter of 2024, the net loss was $1.7 million. So even though they have revenues now, the investment in growth and the increased expenses have led to a much larger net loss for the period. The weighted average number of common shares outstanding also dramatically increased to over 3 million in the third quarter of 2025, compared to about 579,000 a year ago. This indicates that they have issued a lot more shares, likely through financing and the merger, which can dilute the value of existing shares if things don't go well. Looking at the balance sheet at the 31st of December 2024, Pelthos had very little in the way of assets, only $1.4 million in total assets, with only $1.4 million in total current assets. Their total liabilities were around $4 million, leading to a negative stockholders' equity of negative $2.7 million. They were in a precarious financial position. Fast forward to September 2025, and the picture is dramatically different. Total assets now stand at $126.4 million, and total liabilities are $68.2 million. Their stockholders' equity is now a positive $58.3 million. This transformation is primarily driven by the merger and the subsequent financing deals that brought in substantial capital and new assets. A key event driving these changes was the acquisition of LNHC Inc. This July, Pelthos essentially acquired LNHC. This merger significantly reshaped their balance sheet, adding substantial assets and liabilities. The fair value of net assets acquired was $8.8 million, but due to the purchase price, they also recorded $30.6 million in goodwill. This goodwill represents the premium paid over the fair value of the identifiable net assets, likely due to expected future benefits and synergies from the acquisition. They also have a significant liability related to the Reedy Creek purchase agreement. As of the 30th of September 2025, this long-term liability, including the current portion, is valued at over $20 million. This agreement is treated as a financing arrangement, and they are accreting interest on it, which adds to their interest expense. Similarly, they have a ZELSOVMI royalty agreement with a carrying value of over $9 million for the long-term portion. This represents a sale of future revenue streams for their main product. These royalty obligations are treated as liabilities and accrue interest, impacting their financial results. Looking at their cash flow, net cash used in operating activities for the 9 months ending September 2025 was $16.3 million. This large outflow is largely due to their net loss of $21.7 million, offset by non-cash items like stock-based compensation and the increasing interest expense on their debt and royalty obligations. On the financing side, they saw a significant inflow of $27.3 million for the 9 months ending September 2025. This comes from their PIPE financing and other capital raising activities. This inflow was crucial for fueling their operations and the ZELSOVMI launch. Now, a critical point, the report explicitly states substantial doubt about their ability to continue as a going concern. Despite the recent financing and product launch, they expect to continue incurring losses. They will need to get more money to fund operations, especially with the ZELSOVMI launch and potential future trials. This is a serious concern, highlighting their heavy reliance on external funding. Interestingly, the report also highlights that their disclosure controls and procedures were not fully effective. They identified material weaknesses such as a lack of segregation of duties, insufficient review processes in financial reporting, and infrastructure issues. This is concerning because it means there could be risks of errors or fraud in their financial reporting. They are working on integrating LNHC's operations, which may change these controls. On the legal front, there is the Copley matter. It seems they were involved in a lawsuit with their former CEO Christian Copley and Chromacell Holdings. The company won a default judgment of over $17.9 million against them. This is a significant legal victory for Pelthos. Looking ahead, Pelthos has secured another $18 million in financing through convertible notes, which closed in November 2025. This financing provides some breathing room, but it also comes with significant royalty obligations on other products, including Xepi, and the right to receive payments from the SATO agreement. This shows their ongoing strategy of using future revenue streams to fund current operations. Another big move is the acquisition of Xepi, a topical cream for pain from Biofrontera for up to $10 million. This expands their product line beyond ZELSOVMI and into pain management, though it also adds complexity and new financial obligations. So, what is the story here? Pelthos is in a high-stakes transition. They've gone from a company with virtually no revenue or assets to one with a commercial product and significant financial activity, all thanks to a major merger and a series of financing deals this year. The ZELSOVMI launch is a huge step, finally generating revenue. However, the massive increase in expenses, especially SG&A, and the substantial liabilities from royalty agreements and the ongoing need for capital raise major red flags. The going concern warning is a stark reminder of their precarious financial footing. While they have exciting products and a new revenue stream, their survival hinges on effectively managing costs, successfully commercializing ZELSOVMI, and securing additional funding without diluting shareholders too much, or taking on unmanageable debt. The internal control weaknesses also add a layer of caution. They've certainly made bold moves, but whether those moves will lead to long-term success remains to be seen. Alright, that is our breakdown of Pelthos Therapeutics Inc.'s latest quarterly report. What is your take on these numbers, this bold merger and financing strategy, and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for even more discussions. Thanks for watching. See you next time.